Have you experienced investing before? Maybe you built a business or bought a stock, and you have that strong feeling inside telling you that your investment will skyrocket. You put all your savings into that, then something unfortunate happened. Well, I hope that didn't happen to you. As we all know, some people want to have an investment so they can earn passive income. Maybe they don't want to rely solely on their jobs, or so that they can retire as early as possible and live a happy life in the countryside. Some people just want to multiply their savings, and so maybe they can buy a new car or a house sooner. But some people just want to have several income streams for their path to becoming a millionaire. If you're watching this, I think you have an idea of what investing is, or maybe you have experience in investing. Another question is, have you experienced taking out all your savings and maybe borrowing money from a loan, and then you lose all of the money instead of multiplying your capital? If you want to learn more about the reason why you're over-investing and how we would solve it, then make sure to watch until the end. First, let's talk about the possible reasons why you tend to over-invest. Have you heard the word emotional investor? An emotional investor is someone whose investment decisions are significantly influenced by emotions like fear, greed, excitement, etc., rather than following a rational analysis or a disciplined strategy. To solve your over-investing problem, you have to identify which type of emotional investor you are. There are 5 main reasons why people get emotional when it comes to investing. First on the list is the herd mentality. Human beings have a natural tendency to follow the crowd. When everyone around them is investing in a particular asset or following a specific strategy, people may feel urged to do the same without conducting proper research or considering their own financial goals and risk tolerance. Imagine this. Andrew, a newbie in investing, searches through the internet on what is the best stock to buy now. Andrew found a post from a person he didn't know, saying that this stock would pump significantly within a few days. Andrew checked through the comments and searched different posts with similar content, and they all said the same. Thinking that he had just found his opportunity to be rich, he used all his savings and borrowed money from his family, friends, and banks to invest in the stock. Several days had passed, and the stock he bought had no sign of pumping up and continuously dropping its value. In the end, Andrew lost a fortune and is now in debt. Now, what you need is to do your research. Make sure to take the time to research and analyze investment opportunities thoroughly. Develop your understanding of the market trends, and the fundamentals of the investments you are considering. Relying on your analysis will help you make informed decisions based on your judgment, rather than simply following the crowd. Remember, trends are guides but not the truth. Second on the list is the overconfidence. Past successes in investing can lead to overconfidence, making people believe they have a special ability to predict the market or pick winning investments. This overconfidence can cloud judgment and lead to taking excessive risks or ignoring warning signs. Imagine this. Benjamin, an amateur investor, profited several times from his investment. His portfolio had consistently outperformed the market, boosting his confidence to new heights. He believed he had cracked the code and possessed a unique ability to predict winning stocks. Ignoring warning signs, he poured all his savings into a high-risk investment. However, his luck ran out. The market turned and his investment dropped, erasing his gains and leaving him with heavy losses. Benjamin learned a humbling lesson. A past success does not guarantee future triumphs. He realized the importance of diligent research and avoiding complacency in the ever-changing world of investing. Now, to avoid being swayed by past successes, it's important to remember that past performance does not guarantee future results. Conduct thorough research and analysis for each investment opportunity, regardless of your previous successes. And the most important of all is to diversify your portfolio to spread risk and avoid relying too heavily on past winners. Third on the list is greed and excitement. The prospect of making quick and substantial profits can trigger emotions of greed and excitement. Investors may get caught up in investment trends or speculative opportunities, disregarding the potential risks and making decisions based solely on the desire for higher returns. Imagine this. Catherine, an avid investor, was always hunting for the next big opportunity. When rumors of a revolutionary tech company hit the market, she couldn't resist the allure of potential fortunes. Driven by greed and excitement, she diligently invested a significant portion of her savings, ignoring any warning signs. The stock soared initially, fueling her excitement. However, the company's flaws soon became evident, causing the stock to drop. Catherine's excessive desire for wealth had clouded her judgment, and she learned a valuable lesson about the dangers of chasing quick profits without thorough analysis and consideration of risks. To overcome this, establish a disciplined investment plan and stick to it. Set clear goals and define your risk tolerance. Avoid chasing hot tips or get-rich-quick schemes. Keep emotions in check by following a rational approach and avoiding impulsive decisions driven by excitement or the fear of missing out. Now we're done exploring the dopamine rush categories in emotional investing. Are you ready to learn more about anxiety investing? If so, sit tight because we're about to share it with you. Fourth on the list is fear and panic. During times of market volatility or downturns, fear and panic can take hold. Investors may become overwhelmed by negative news or the fear of losing their hard-earned money, leading them to make impulsive and irrational decisions. Imagine this. As news of an economic downturn spread, fear gripped Dominic's heart. He witnessed his investments dwindling and panic took hold. Driven by fear of losing everything, he hastily sold his holdings at rock-bottom prices, hoping to recover whatever he could. However, the market rebounded soon after, leaving Dominic filled with regret. He realized that acting out of fear and panic can often lead to poor decisions and missed opportunities. Dominic resolved to approach investing with a calmer mindset, understanding that market fluctuations are part of the natural cycle and that staying the course is often the wiser choice. To fight fear and panic, focus on a long-term investment strategy and avoid making reactionary decisions based on short-term market fluctuations. Establish an emergency fund to provide a sense of security during volatile times. Regularly review your portfolio and make adjustments based on thorough analysis rather than emotional responses. Seek guidance from a trusted financial advisor who can provide objective advice and help you stay calm during turbulent market conditions. Fifth on the list is the risk intolerance. People tend to feel the pain of losses more strongly than the pleasure of gains. The fear of realizing losses can cause investors to hold on to declining investments for too long, hoping for a rebound or to sell winning investments prematurely to secure small profits. Imagine this. Emma had always been risk intolerant. The thought of losing money terrified her, causing her to shy away from potentially lucrative investments. She clung to low-risk options, sacrificing potential gains for a sense of security. However, her conservative approach limited her returns and hindered wealth accumulation. Emma's risk intolerance prevented her from taking calculated risks that could have propelled her financial growth. To overcome risk intolerance, recognize that losses are a natural part of investing. Set realistic expectations and understand that not all investments will be successful. Diversify your portfolio to mitigate the impact of individual losses. Consider maintaining a long-term perspective and avoid making impulsive decisions to sell investments based solely on short-term losses. Regularly review your investments and rebalance your portfolio to align with your long-term goals. Emotional investing can be a challenging pitfall to control. However, by recognizing and addressing the various categories of emotional investing, you can take steps to avoid their detrimental effects. Whether it's the lure of past successes, the grip of greed and excitement, the paralyzing grip of fear and panic, intolerance to losses, or the lack of information and understanding, awareness is key. By adopting a rational and disciplined approach, conducting thorough research, seeking professional guidance, and keeping a long-term perspective, you can mitigate the impact of emotions on your investment decisions. Remember, investing is a journey that requires patience, knowledge, and a steady hand. Lastly, always remember to seek guidance from a trusted financial advisor who can provide objective advice and help you stay calm during turbulent market conditions. If you have a similar story with emotional investing, please tell us your thoughts in the comments section below. And if you found this video helpful with your investment, then you're in for a treat with our next video. Until next time, have a great time investing.